Let's talk about transitioning from S corporation to C corporation. What are the tax implications? So here's an overview I want you to pay attention to. So when we talk about S corporation to C corporation conversion, there are some benefits and there are some considerations you need to really think about. The thing is that tax law changes in recent years provide an opportunity for business owners to reassess the current tax structure of their entities, especially after COVID. A lot of folks are just thinking like, okay, am I in the right tax structure here? So depending upon your specific circumstances and overall goals, converting from an S corporation to a C corporation could be a worthwhile tax strategy. Now, there are several factors that you need to consider, and this decision should be made after consultation with your tax provider, of course, okay? And so let's first talk about a few things you need to really pay attention to here. First of all, what are the benefits of an S corporation? I want to really go back to S corporation 101 real quick, so we are on the same page here. So when we talk about S corporation benefits, so you are able to offset income taxes, you have preferential tax rates, you have reduced personal liability, and you have tax-free distributions. Let me quickly go granular here. So you are able to offset income taxes. So business earnings will flow through to your personal tax return and are subject to a single level of tax at individual tax rates, right? So we're speaking here about pass-through taxation. So assuming qualifications are met, the income that's ultimately taxed should be reduced by the 20% qualified business income, the QBI deduction. If you experience a tax loss from the entity, you can generally use it to offset other forms of income on your personal tax return. So when you file your Form 1040 Schedule C, you'll be able to actually sort of offset losses with profits on that form. You also have preferential tax rates. So components of your company's income are eligible for preferential tax rates. And so this is kind of cool. So, but this depends upon the specific industry you're in though. You also have reduced personal liability. So beyond your tax status, your tax results rather, your S corporation could shield you from personal liability related to any business liability. So you'll be also able to limit complexity to a degree amongst different shareholders with the requirements that all earnings, distributions, and contributions be allocated or incurred on a pro rata basis based on ownership percentages. And then you finally also have tax-free distributions. So provided sufficient tax bases and positive accumulated adjustment accounts, you will be able to distribute money from the corporation in a tax-free manner. So your stock basis in the corporation increases to the extent of undistributed earnings, which will be of value to you should you decide to sell your company in the future. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. So let's talk about the impact of a C corporation conversion. Again, we're still talking about from S corporation to C corporation, the transition. What are the tax implications? So as a C corporation, some of the benefits described earlier will no longer apply. So taxes cannot be offset. You are ineligible for a QBI deduction. You cannot actually have preferential tax rates, and distributions are taxed. Let me really sort of go granular here. Since taxes cannot be offset, since C corporations pay their own tax at the entity level, any losses will not be available to offset other items of income their shareholders might have. You also will be ineligible for a QBI deduction. So C corporation income doesn't qualify for the QBI deduction. You also have the fact that you don't have preferential tax rates. So the tax rate in a C corporation applies to all items of income, which negates the benefit of preferential tax rates on items associated with the specific industry you might be in right now. You also have distributions that are taxed. So if a C corporation accumulates earnings, distributions shareholders require will not be tax-free. Okay, and so I'm speaking here about dividends. So distributions out of a C corporation are taxed as dividends to the shareholders, which creates a double tax environment, right? That's why for businesses, for C corporations, experts talk about double taxation. C corporation earnings are taxed, and after tax dollars in the C corporations are taxed again when they are distributed. So if you're listening to me right now, if you're a shareholder, if you're a C corporation shareholder, when you file your taxes, so first of all, when the C corporation actually files Form 1120, it has to pay taxes on those, and when it distributes dividends to you, you have to also pay taxes when you actually file your Schedule C Form 1040. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about transitioning from S corporation to C corporation. What are the tax implications? Let me quickly talk to you about the benefits of a C corporation, because it's really important to understand that you have, as you actually analyze the tax implications of the transition, you also need to think about the benefits of a C corporation in the first place. So the loss of this S corporation advantages doesn't go unanswered. What I just told you earlier. So after the passing of the tax law of 2017, commonly referred to as the Tax Cuts and Jobs Act, the TCJA, the C corporation tax rate reduced to 21%. So this is really cool because, when you think about C corporation tax rate at 21%, think about, I want you to compare that to the top individual rate of 37%. This is really, really kind of huge. And of course, it is 29.6% if the taxpayer receives the full benefit of the QBI deduction. And C corporation can also deduct all state taxes, whereas state taxes paid by individuals related to S corporation earnings are capped at $10,000 on their itemized deductions, unless earnings are from states that allow the S corporation to take a deduction, which requires an election, and not all states have this opportunity. Okay, and C corporations can also have unlimited owners with no restrictions on the types of owners allowed. This can make raising capital easier. So the question here is that, does an S corporation to a C corporation conversion makes sense to you? Well, it really depends. But let's really dig a little deeper here. Given the high level description that I said earlier to you in terms of the conversion, a deeper dive explanation really follows. Okay, first of all, you have a capital gain treatment. This is an important element. You have distribution. You have an exit strategy. So I'm just talking to you about what really could actually trigger, or what could really underlie a successful conversion from an S corporation to a C corporation. So when we talk about capital gain treatment, so it really depends upon your specific industry, okay? But every industry has different configurations here. But those are things you need to really pay attention to. If you want to know more, just let us know in the comment section, and let us know your industry, let us know your city and state, and we'll let you know what kind of capital gain treatments you should consider. Also, think about distributions. So S corporation shareholders can actually receive distributions from the company tax-free. Distributions are also required to be pro rata in the S corporation environment. So to the extent that your company distributed funds that shareholders are accustomed to receiving and possibly rely upon in their personal situations, converting to a C corporation could impact a company's ability and incentive to continue distributing funds, as these distributions will no longer be tax-free. So cash flow needs of the shareholders should also be considered when determining whether a conversion makes sense. Also, think about exit strategy. So understanding your exit strategy and the long-term goals of the company are kind of essential to determining if a conversion makes sense at all, right? Because as an S corporation, let's clarify things here. As an S corporation, every dollar of earnings increases your stock basis, and every dollar of loss or distribution decreases your stock basis. So these adjustments accumulate over the life of the S corporation and are extremely important when considering a sale of the company. So in simplified terms, you will compare the amount you sell the company to your stock basis to evaluate your tax gain on the sale. The closer your stock basis is to the sale price, the lower the gain, the more dollars stay in your pocket after considering taxes. Conversely, once you switch to a C corporation, your stock basis is essentially frozen at the time of conversion. All the earnings from the point of conversion to the time of sale do not impact your stock basis. And at the time of a sale, you will most likely have a much larger tax gain. In some cases, the entirety of tax savings experienced from switching to a C corporation can be completely undone at time of sale. Let me give you other considerations you need to really think about. So, since the decision to convert to a C corporation should be considered from multiple angles, there are also several other items that you should actually address in detail with your tax provider. So, I'm talking about you reaching out to a tax attorney, you're reaching out to an enrolled agent, you're reaching out to a certified public accountant, or somebody who really understands the tax nuances of your specific business. And again, when I'm talking about tax nuances, I'm speaking about things at the state level, at the federal level, but also at the local level. So there are a few things you need to really discuss. Estate planning and wealth transfer plans may need to be reassessed when thinking about a new corporate structure. Conversion to C corporation comes with a 5-year restriction before converting back to an S corporation, with some exceptions. So this sort of 5 years are really some of the reasons why you want to talk to an expert before doing the conversion at all. And tax planning around the strategic use of a post-termination time period to distribute S corporation earnings also. You also got to think about LIFO. So we are speaking here about inventory valuation. So last in, first out, LIFO inventory and other gain deferral recognition upon conversion back to S corporation. Remember, when we talk about inventory is an asset. So when we talk about proper inventory valuation, we're speaking about your balance sheet. You do not want your balance sheet to be understated or overstated. You also have complexities with determining historical earnings and profits if the entity was a C corporation before initially converting to an S corporation. You got to also think about the impact of conversion on current qualified subchapter S subsidiaries. So that's what we call the Q subs, and ramifications to overall tax reporting. You got to also think about the necessity of a tax provision analysis for financial statement presentation purposes, and also think about the future. It's really important to project yourself in the future. So look at the impact of future law changes. So what I'm trying to say here is that if you're thinking about converting from S corporation to a C corporation, you want to think about the future law changes, especially as they have an impact on your tax situation. Boss, I want to quickly remind you of today's topic. We are having a conversation about transitioning from S corporation to C corporation. What are the tax implications? Let me give you the approach here. So the thing here is that why should you convert your tax status from S corporation to C corporation in the first place? It's one of those things where you have to understand that situations actually change, right? But it really depends upon your vision. Now, the following requirements. The thing is that when we talk about transitioning, well, first of all, the most common change in taxation status is from a C corporation, usually a general corporation, to an S corporation, in order to allow for pass-through taxation of income or loss. This is typically done to avoid double taxation of corporate income. However, business owners who sometimes want to convert their tax status from an S corporation to a C corporation usually do so because their companies no longer meet the requirements outlined by the IRS to be considered an S corporation. Okay, so in other words, you do not want to violate the law. That's why you're just like, you know what, let me just quickly go back to a C corporation. So the thing here is that the following requirements must be met in order to retain S corporation tax status. Let's talk about that real quick. You must file IRS Form 2553 in a timely manner. You got to have approval of all shareholders of the corporation. Basically, an S corporation is limited for all intents and purposes to no more than 100 shareholders. So, that number, the IRS pays attention like crazy. Like they actually pay attention all the time to it. And shareholders cannot be non-resident aliens. Shareholders cannot be other S corporations. And you cannot have more than one class of stock. So if any of those requirements are not met, you must convert the tax status of the corporation. For example, you will need to change your corporation's tax status if you want to increase your company's number of shareholders with the goal of receiving additional funding, or if you like to bring on foreign investors. Another reason to change the tax status is if your corporation would like to accumulate income without the shareholders being taxed on their portion of the retained income. And if your corporation is the C corporation, the shareholders are only taxed on the dividends they receive, right? And if your company violates any of the S corporation requirements, the IRS can automatically terminate your company's S tax status. Let's quickly talk about how to convert your tax status from S corporation to C corporation. How do you do it quickly and how do you do it seamlessly? First of all, think about revoking an S election. Think about income allocation for mid-year revocations. You got to think about tax accounting considerations. You got to think about the subsidiaries, the Q subs that I just spoke about earlier, and think about the distributions following a revocation, and think about the requirements that money be distributed. Think about suspended shareholder losses at the time of revocation, and think about the other elements that are kind of important for you. Now, let me quickly talk about some of those things here. So when we talk about revoking an S election, S corporations need not incur a traditional terminating event to end an S election. With majority shareholder consent, an S corporation may simply revoke its election. So you want to contrast that with the unanimous consent that will be required if in the future the entity re-elects subchapter S status. And so S corporations can choose the day on which the revocation is effective. The key here is to be aware of the timing for filing the revocation, and unless a different date is specified, the revocation filed by the 15th day of the third month of the tax year will be effective retroactively to the first day of the tax year, and a revocation filed after the 15th day of the third month will be effective on the first day of the following tax year. So basically, you have some kind of timing. So the chronology here is really important, okay? And if we talk about income allocation for mid-year revocations, those depends upon your specific industry. If the taxpayer chooses a revocation date in the middle of the S corporation's tax year, then 2 short period returns will be required in the termination year. So one S corporation return covering the period from the beginning of the tax year through the day preceding the revocation date, and one C corporation return covering the remainder of the tax year. So those are really important. Think about your tax accounting considerations. So I'm not going to go in details here. You just reach out to a CPA to kind of help you out, or let us know in the comment section if you need more information. Same thing for the Q subs and also the distribution following a revocation. Let me give you a few extras here before we close to this conversation. When we talk about transitioning from S corporation to C corporation, and most importantly, the tax implications here, remember that everything depends upon where you're currently at, so your current situation. But most importantly, you also have to pay attention to your state tax laws, because everything that I've spoken to you about today really sort of revolves around the federal tax implications of things. But if your state has a specific law, you want to make sure that you have a clear idea what those laws are. Because see, the thing is that every state has a different set of rules when it comes to S corporation, when it comes to C corporation. Some states might actually allow the conversion to go smoothly, quote unquote, and some states might want you to go through a series of procedures to be able to actually do the conversion. So it's one of those things where when we speak about the conversion is happening simultaneously at the federal level, but also at the state level. And in some states, the conversion is just not impossible. This is just not possible. In other words, if you are trying to convert from S corporation to C corporation, maybe that conversion is not possible within your state, which means what? Which means that you might have to actually just dissolve the S corporation at the state level and then form a new C corporation, or go from S corporation to LLC and then from LLC to C corporation. So you might have to have instead of having a shortcut, you might have a long cut here. But the bottom line here is that you always have to, when in doubt, you always have the ability to reach out to a professional in your field, somebody who understands the local aspects and also as well as the federal aspect of your business, so to be able to help you out. And also, and again, when we talk about an expert here, we're always speaking about 3 types of quote unquote valid experts. So you want to have a certified public accountant, you want to have a registered agent, or you want to have a tax lawyer. So any of those three will be able to help you out. Please, we're not saying that a regular tax preparer cannot really help, but I just want to insist on the fact that you want somebody who understands the ins and outs of S corporation taxation and of C corporation taxation. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about transitioning from S corporation to C corporation, the tax implications. So I gave you the overview, the approach, and the extras. Thank you so much. God bless you. I'll see you next time. Until then, remember, stay marvelous.